Hi, this is Dave Ryan, and I decided to put together this little training video based on a blog post that I did that explained why it was important for entrepreneurs that don't have finance training and finance background to understand key terms around finance. And in this context, we're going to talk about some key financial terms that are important for subscription businesses / SaaS businesses. So we're going to talk about key revenue recognition concepts and metrics. And very important to understand, number one up front, I'm not a CFO, I'm not a trained finance guy. And as I said in my blog, that really gives me a unique position to be able to explain these terms to my fellow entrepreneurs and business people who don't have a finance background. That also, from a disclaimer perspective, understand this is an overview. This isn't going to make you an expert, but it will give you some core foundational concepts that you can use when discussing key finances with people, when chatting with finance people, so you don't sound as ignorant as I know I have in the past. So in your term subscription agreement, which is going to apply to most SaaS companies, as well as traditional software companies that use a subscription licensing model, your agreement is going to define legal terms and conditions, and it's going to define financial terms. Inside the financial terms, you will have contract elements. The contract elements, you can have a number of different contract elements inside of your financial document, but contract element is a formal term used in the finance community. It's not used much operationally inside businesses, but if you go talk with finance people, accountants, whatnot, you will understand that this concept, contract element, is well understood. And your contract elements in a term subscription agreement likely are going to include a line item for a subscription. You may call it something else, maybe called a term item or something. It may be called a product name, but that subscription is something that has a start date and an end date and includes a cost or a price. Your contract may also include a contract element for professional services, training, custom coding, integration, implementation services. All of those things would be considered professional services. Your subscription agreement may also contain one line items for one-time things like a license fee. You don't see this a ton in SaaS companies, but you do see it in traditional software companies. And then you may also have a contract element for variable fees, sometimes referred to as consumption fees or usage fees. These are things like, you bought X capacity, you used Y, so you pay us more, or you get Z per month and you use Z plus 5, so you pay us for the 5. Okay, so these are the typical elements that you will see in a contract. And then, of course, your contract defines how things are going to be paid, quarterly, monthly, et cetera, et cetera. Now, the contract element financial components break down as follows. Each contract element, which we call or I call transactions, a lot of people call them transactions, but they're contract elements technically. Each one will have a revenue schedule. It's a very, very, very important concept to understand that each contract element has its own revenue schedule. And then the contract itself will have invoices. You may have one or more invoices for the contract. Your invoices may include invoice line items that cover multiple contract elements. But really, again, really important concept is each contract element has its own revenue schedule. And then the contract or the contract element could have one or more invoices. So we're going to take you through an example now, an example agreement, very typical in the SaaS world. And I picked a decent-sized transaction, but instead of a couple $100,000, this could be $20,000 transaction. So the first element is the subscription contract element. We're going to have it run from July 1 through June 30, a year later. So it's a one-year agreement. It's a $120,000 subscription. And we'll come back and talk about this, but this is typically what people would call the booking or the booking value. We've agreed in the contract that this is going to be billed up front, and just for purposes of being kind of thorough, there's an evergreen clause in here that will auto-renew this subscription contract element unless it's canceled in writing. Okay, so that's element one. Element two is an implementation element. It's the implementation contract element. To be completed by 9/1. In this case, just assume that it's some training. And this is a very important concept here to define this as training, because certain types of professional services and implementations that impact the subscription have an impact on the revenue recognition or revenue recognition schedule of the subscription. We're not going to go into that in this particular example, but that's part of what's important about understanding these concepts is these contract elements can interrelate with each other and can affect the revenue recognition schedules of each other. We're saying that the training will be completed by 9/1. It's $36,000, and we've agreed we're going to bill it on 8/1 and 9/1. And then the third component is a one-time license fee contract element. It's a $60,000 one-time fee. We used to charge these at my old company, Marketing Central, and we called it the college fund. There was, we just used it as a cash flow generator. We just charged people a license fee, and in this case, we've agreed to bill it quarterly. So if we take a look at each of the contract elements, this is the first one. This is the subscription. We can see it's $120,000. So the transaction itself starts on 7/1 and ends on 6/30/2012. It's $120,000. Below it, you can see the revenue schedule. Now, for our example, we've used an even monthly revenue schedule of $10,000 a month over the life of the term. Okay, in the real world, you prefer to use a daily recognition schedule, but for purposes of examples here, this is good. Also, most people who do revenue recognition in spreadsheets do it this way because it's impossible to do it the right way, which is a daily revenue recognition schedule. So this is something you may have seen before. And then down below, we've got the third line is the invoice line. We've got one invoice we've agreed to in the contract, which is $120,000 on 7/1. So these are the components of the breakdown of the things that are financially oriented in this first contract element. If we go take a look at the future of this one, by the way, just to kind of look out, well, what happens a year from now? Well, maybe a year from now, we upgrade this customer or upsell the customer, and the subscription renews because it has an end date, and we have an evergreen clause that's going to renew. Maybe in this case, it goes in for 160. The important point here is that there's a separate revenue schedule for that second leg, or that term number 2 of this transaction when it goes into its first renewal. You can see there's a different revenue schedule for that, and in fact can be a different invoicing schedule. Maybe as part of that renewal negotiation, we agreed to bill them quarterly and not penalize them with any kind of a fee there. So you can see what that transaction looks like into the future. Now, if we go back to our second contract element, which is the implementation or training, it's $36,000. It starts no earlier than 7/1 here and ends as agreed to by the end of August. The revenues, again, are going to be broken up over 2 months. We're going to take $18,000 in July and $18,000 in August. Now, there's a lot to learn about revenue recognition with the delivery of professional services. Once again, this isn't designed to be a comprehensive course on revenue recognition. I'm not qualified to give it, first of all. But it's important, again, to understand that we're going to recognize this revenue over this period of time when we're delivering these professional services. And then we've agreed to invoice. And you can see here we're invoicing in arrears. We're invoicing half of it on August 1st and half on September 1st. So here is our third contract element, the license. Now, with the license, this is a particularly interesting one, and I added this for purposes of really showing you how complicated this can be in the real world. It's a $60,000 transaction on July 1st. However, we're going to recognize the revenue for this transaction over a 2-year period. Why? Well, in this example, which comes from the real world, because the auditors said that's how it had to be done. And in the end, the auditors, if you're a public company, the auditors will dictate that. If you're not a public company, you're best to get the opinion of somebody who represents a public company, because eventually, if you don't go public, you'll be acquired by somebody who's public, or you'll be doing something else for a living. And if you're acquired by somebody who's public, they're going to want to look at your contracts and kind of reconcile them, and they want to roll them into their financial model. So it's always a good idea to be conservative with the way you recognize revenue for things that are one time, like a license fee, that isn't real clear. Best to do it over a longer period of time. But again, seek advice from your financial counsel on that. And then we've agreed in the contract that we're going to invoice the $60,000 quarterly starting on 7/1. So those are our 3 contract element transactions. Now, very, 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 very important concept here to understand is that generally speaking, and I use the word generally, Metrics relate to the transaction, and financials relate to the revenues and the invoices. So when you're out and about doing your startup stuff, your CEO stuff, your VP developments, whatever role you play in a small organization, it's really important to understand that the finance people will speak financial language, and their language typically is built around variations of reporting on revenues and invoices. Whereas you go to product management, marketing, sales, you typically talk about metrics. What kind of metrics and what kind of financials? Well, you'll hear things like bookings, churn, which is very, very important for SaaS companies and subscription companies, MRR, monthly recurring revenue, renewal rates, which is the complementary term to churn, average contract value, customer lifecycle value. Okay, these are the common metrics that you will hear. It's very important to understand there are no universal definitions for what is a booking or what is churn. One person measures churn one way, another company measures it revenue churn, another company measures booking churn. Churn can be measured by counting contracts, by a normalized value like monthly recurring revenue, or maybe normalized annually. The point with metrics is, again, there's no oversight committees. You define the metrics that are important to you, and you report and run your company around those metrics. And you discuss those metrics in operational meetings, and you may very well discuss those metrics with board meetings, and you may discuss them with venture capitalists, and you may discuss them with people who are looking to acquire you. When you flop down to the financials, it's a totally different story. Financial terms and financial rules are fairly well defined, and they can be very complicated, but they're fairly well defined. And the reason we do that is that our financials are a way to normalize businesses so that we can understand how does business A do against business B. And this all comes out of the public accounting and publicly traded stocks. So if you want to understand how's a business doing, you need to have some ability to compare it to something else. So financials, unlike metrics, are very regulated, very, very well defined. Now there's still room for interpretation, but again, there are lots of rules, and there are boards like the Financial Accounting Standards Boards, there's the Securities Exchange Commission, there's international organizations, there's GAAP, generally accepted accounting principles, that define how you calculate these things. And the key financials that really are related to term subscriptions are the revenue, deferred revenue, and unbilled AR. Again, as you're an entrepreneur and you're doing tax returns or someone's doing them for you, you're not going to see deferred revenue and unbilled AR. But if you're producing financial statements, then you need these. And the reason you produce financial statements is the people who are the big fish are going to eat you work in that world.